You know that feeling when you're scrolling through your brokerage app at 2 a.m., looking at your boring index fund returns, and you see someone on Reddit claiming they turned $500 into $5,000 in 3 weeks with leveraged ETFs? And part of you is thinking, that could be me, while another part is whispering, this sounds like a terrible idea. Yeah, we need to talk about that. My name is Oric, and I spend way too much time thinking about leveraged exchange-traded funds and why they absolutely wreck most people who touch them. If you're someone who's sick of 8% annual returns and you're wondering if there's a way to accelerate your wealth building without going full degenerate gambler, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. So here's the thing. Leveraged ETFs are one of those financial products that sound amazing in theory and absolutely disastrous in practice for about 90% of people who use them. And I know what you're thinking. Oric, if they're so dangerous, why are you making a video about them? Because look, I'd rather you understand exactly what you're getting into than learn the hard way by watching your $100 turn into $47 in 2 months during a choppy market. Let's start with what a leveraged ETF actually is, because most people don't truly understand the mechanics. A regular ETF tracking the S&P 500 goes up 1% when the market goes up 1%. Simple, right? A 3x leveraged ETF is designed to go up 3% when the market goes up 1%. On the surface, this sounds like free money. Triple the gains? Sign me up. But here's what most people don't realize. That 3x leverage resets daily, every single day. This is absolutely critical, and it's where people get destroyed. Let me show you with real numbers why this matters so much. Let's say you put $100 into a 3x leveraged S&P 500 ETF. On day 1, the market goes up 5%. Your investment goes up 15%, so you now have 115. Awesome, right? Day 2, the market drops 4%. Your leveraged position drops 12%. You'd think you're still up, right? The market is net positive at this point. But let's do the math. $115 minus 12% is $101.20. Now compare that to if you just held a regular S&P 500 ETF, up 5%, then down 4%. Your $100 would be at $100.80. Almost the same, right? This is where it gets really interesting. Now imagine this volatility continues. Up 3%, down 2%, up 4%, down 5%, up 2%. The market might end up roughly where it started, maybe slightly positive. But that leveraged ETF, it's getting hammered by something called volatility decay. A study by Morningstar found that during 2008 to 2009, the Financial Select Sector Index fell about 75%, but the corresponding 3x leveraged ETF fell 99%. Let me repeat that. The index lost 3/4 of its value, and the leveraged version essentially went to zero. So why does this happen? It's all about that daily reset and compound mathematics working against you. When you lose money, you need a bigger percentage gain just to get back to even. If you lose 50%, you need a 100% gain to recover. The leveraged ETF magnifies this effect brutally. Let me give you a concrete example with your $100. Let's say you're trading TQQQ, which is a 3x leveraged Nasdaq ETF, one of the most popular ones out there. On a good day when the Nasdaq is up 2%, you're up 6%. You feel like a genius. Your $100 is now $106. But then we get one of those days, and if you've been paying attention to tech stocks, you know these happen. Nasdaq drops 3%. You're down 9% from your new high. Your $106 becomes $96.46. Here's the thing that messes with your psychology. You're now down 3.54% from your starting point, but the Nasdaq is only down 1% total. The math isn't working the way your brain expects it to. And this is before we talk about what happens in a real correction or bear market. Now you might be thinking, okay, Oric, but what if I just use these during a strong bull market and get out before things turn? And look, this is actually the only scenario where leveraged ETFs make any sense for retail investors. But you need to be honest with yourself about something. Do you have the discipline to actually do that? Because here's what actually happens. Let's say you start with your $100 in a 3x leveraged ETF at the beginning of a bull run. Things are going great. You're up 40% in 3 months. Your $100 is now $140. You're feeling smart, checking your portfolio every day, maybe posting your gains. Then we get a 5% pullback in the underlying index, a totally normal, healthy pullback. But your leveraged position, it drops 15%. Your $140 becomes $119 overnight. Most people panic here. They're thinking, I need to protect my gains, or what if this is the start of a bigger crash? So they sell. They lock in their $19 profit. Not bad, right? Except the market recovers the next week, and if they'd held a regular index fund, they'd be at $145, but they sold, and now they're watching from the sidelines, trying to time their re-entry, and we all know how that usually goes. A study from Vanguard found that the average investor underperforms the market by about 1.5% annually, and that's with regular investments. With leveraged products, that behavior gap gets multiplied. Dalbar research shows that when investors have access to more volatile products, they actually make worse timing decisions because the emotional swings are more intense. So let's talk about the scenarios where your $100 in a leveraged ETF could actually work. First scenario, you have a very strong conviction about a short-term directional move. Notice I said short-term, like days or weeks, not months. You think tech earnings are going to crush it this quarter, and you want amplified exposure for 2 weeks. You put in $100, you set a stop loss at $85, and you set a target at $130. You manage it like a trade, not an investment. Second scenario, you're using it as a small part of a larger portfolio for tactical allocation. Maybe you've got $10,000 invested, and you put $100 into a leveraged position as a satellite holding while keeping $9,900 in boring, stable investments. That $100 is essentially your entertainment budget, money you're okay losing entirely. Third scenario, and this is controversial, you're dollar cost averaging into a leveraged ETF during a sustained bull market with the full understanding that you'll get destroyed in a downturn and you have an exit strategy. Some people did very well doing this with TQQQ from 2020 to late 2021. They also got absolutely demolished in 2022 when tech crashed. The ones who survived were the ones who actually stuck to their exit plans. Here's what most people don't realize about the psychological component. Leveraged ETFs turn you into a day trader, whether you want to be one or not. That 3x movement means you can't just ignore your portfolio. A 2% move in the underlying index is a 6% swing in your position. If you've got $1,000 in there, that's $60 in a single day. Your brain starts treating this like a slot machine. You get dopamine hits from the wins and cortisol spikes from the losses. Dr. Daniel Kahneman's research on loss aversion shows that losses hurt about twice as much psychologically as equivalent gains feel good. So when your leverage position swings wildly, you're on an emotional roller coaster that's probably affecting your decision-making in other areas of your financial life. Let me show you the real math of what happens to your $100 over different scenarios. Scenario 1, steady bull market, market up 20% over 6 months with low volatility. Your 3x leveraged ETF, you might be up 50 to 55%, not the 60% you'd expect due to some volatility decay and fees. Your $100 becomes roughly $150, $155. Not bad. Scenario 2, choppy market, goes up 10% but with significant volatility along the way. The market ends up 10%, but your leveraged ETF might only be up 15 to 20% instead of 30% because of that daily reset eating your returns. Your $100 becomes $115, $120. Scenario 3, bear market. The market drops 30% over a year. Your 3x leveraged ETF could be down 70 to 80% or more due to compounding losses. Your $100 might be worth $20, $30. And here's the really painful part. When the market eventually recovers that 30% loss, needing about a 43% gain to break even, Your leveraged position would need to basically quadruple just to get back to your starting point. Now, I want to talk about fees because nobody seems to mention this enough. Leveraged ETFs typically charge expense ratios of 0.75% to 1% annually. That might not sound like much, but remember, regular index funds charge 0.03% to 1.2%. On your $100, that's only about $1 difference per year, but the fees are calculated daily and they compound against you. Over time, they're another drag on performance. So here's my actual advice if you're determined to try this with your $100. First, treat it as tuition. You're paying $100 to learn how leveraged products work. Set a hard rule. This $100 is all you'll ever put into leveraged ETFs until you've fully learned the lesson. Second, choose a liquid ETF like TQQQ, UPRO, or SQQQ. You want to be able to get in and out easily. Third, set actual rules before you invest. Write them down. I will sell if I'm down 15%, or I will take profits at 30% gain, or I will hold for a maximum of 30 days. Whatever your rules are, commit to them before you put the money in, because once you're in, your emotions will take over. Fourth, track everything. Record the date you bought, the price, what the underlying index is at, and then check daily. Calculate your return versus what you'd have made in the regular index. This is how you actually learn. Fifth, never, ever average down on a leveraged ETF. If your $100 drops to $80 and you think, oh, this is a great buying opportunity, you're about to learn a very expensive lesson. Leveraged products are not for buying the dip unless you have a very specific, time-limited thesis. Look, I'm not here to tell you that you shouldn't experiment with your money. Financial education sometimes requires tuition, and $100 is relatively cheap tuition compared to what some people pay. But I am telling you that leveraged ETFs are not a wealth-building tool for most people. They're a speculation tool, a trading tool, sometimes a hedging tool for sophisticated investors. The path to actual wealth, the kind that changes your life, is boring. It's consistently investing in broad market index funds. It's having an emergency fund. It's maximizing your tax-advantaged accounts. It's increasing your income and investing the difference. I know that's not sexy. I know it doesn't give you the thrill of watching your money triple in a month. But here's the reality. If you invest $100 a month in a boring S&P 500 index fund and it compounds at a historical average of 10% annually, in 30 years you have about $228,000. If you try to get cute with leveraged ETFs and manage to underperform by just 2% annually because of bad timing and volatility decay, you end up with about $150,000. That's $78,000 in lost wealth from trying to be clever. The people making real money with leveraged ETFs are either professional traders with sophisticated risk management systems, or they're the people selling you the ETFs and collecting those expense ratios. The financial industry loves these products because they generate trading activity and fees. So what should you actually do with your $100? If you want to scratch that itch to do something more aggressive than index investing, here are better options. Buy a single share of a growth stock you believe in. At least you won't have volatility decay working against you. Put it in a sector-specific ETF if you think you can identify a trend. Put it in I bonds if they're yielding well. Heck, put it in a high-yield savings account at 4.5% while you learn more about investing. But if you're still determined to try a leveraged ETF with your $100, just remember everything I've told you. This is speculation, not investing. Set your rules, manage your risk, and whatever you do, don't convince yourself you've discovered some secret strategy that the professionals don't know about. They know. They're just better equipped to handle it than you are. The bottom line is this: leveraged ETFs are a tool, and like any tool, they can be useful in the right hands for the right purpose. But most people pick them up thinking they're getting a Ferrari when they're actually getting a chainsaw. Sure, you could build something amazing with a chainsaw if you know what you're doing, but you could also very easily hurt yourself badly. Your $100 is better served learning the fundamentals of wealth building than trying to 3x it in a leveraged product. But if the lesson you need to learn requires putting that $100 at risk, at least now you know exactly what you're getting into. Set your rules, stick to them, and learn from the experience. That's the only way this experiment has value.